everybody, and welcome to another episode of Powerhouse Fin Show. This week, we're going to take a very high-level overview of a few financial terms that are important and one very important financial document. We're going to talk about sales, cost, margins, and income statement, and then part two, we'll come back and we'll go over a balance sheet. I know that's super exciting, so just hang in there. We'll get to it next week. I've had some conversations here recently and I've done some episodes that are very similar to this in the past, and I just thought I would redo it again because there's a lot of people in the world that need this information. So if you listen to this and you think of a person who needs to understand this information, please share it with them. I think every single person who manages, owns, runs a business definitely should know this. I think it would be really awesome for all your key people to understand this stuff. And a really even more added benefit would be if everybody understood the basics of financials and the impact that decisions had on those financials. So that's what we're going to do this week. The show is presented by Memphis Fence Company, Simpalo, and Valgard Strategies Group. So I just want to throw something out real quick. Valgard Strategies Group is a design consulting firm that I decided to start. And I just saw a job that's out for bid that is the first project that Valgard ever worked on. And I thought that was pretty cool to see a job that I'd worked on several months ago and helped some design team with. And it made its life cycle. It's progressed in its life cycle to where it's out for bid. And that's exciting to me. That's cool to see something that I helped with out here on the streets. So anyway, we do have some partners. We have the Thornton Fence Consulting Group. So they do fence consulting. Tony Thornton's been in the fence industry his entire life, I think since he was a very young man, and has held just about every position the industry offers. So if you think he hasn't seen it, you're probably wrong. Fence News, great fence industry publication, giant magazine that they send out. It's pretty cool. Sit back like old school days with the big newspaper, right? Easy G Manufacturing, the big orange equipment that you see at all the trade shows, Fence Hog, Barbar Hog, Mud Hog, stuff like that. We use their equipment. We like it. My Salesman, another tool that we use and we enjoy. In fact, whenever we did residential fence, My Salesman was the mandatory first step in our process. People could not bypass that unless they wanted to pay us to come out and give an estimate. So definitely check that out. The show is live. As always, my phone number is down here on the bottom of the screen. If you want to call me anytime, anywhere, feel free to use that phone number to do so. It is 901-878-4987 for those of you who are listening to the audio. Speaking of listening, let's talk about what I've been consuming. So over the course of this entire year, although we've missed a few weeks, this whole year we've been doing the Be Careful What You Consume type series. So I think it's kind of fitting that I share what I've been consuming, right? So at work, we have our own book club. And the first book that we've been going through is From Drift to Drive by Chris Robinson. It's really neat to sit down and read a book together. And what we do is we meet weekly. We read a chapter of the book. We come back together. We discuss the chapter of the book. There's homework, so to speak, in the book, and we'll do all that and review everybody's work together. Really cool because it gives us all accountability and it allows us a place to have conversations that we generally would not have. So pretty neat experience. And then a few of us also are in the Purple Coaching 2026 year-long mastermind, and we had the first meeting last night. My first time ever being a part of anything like this, and last night was the first meeting. For that book, we're reading the 15 Invaluable Laws of Growth by John Maxwell. And I will tell you, reading two books simultaneously and being a part of two different groups that discuss these books can be a little bit confusing, if I'm being honest. But anyway, we had the first meeting last night. I thought it was really cool. I thought it was awesome. One of the things that really stood out to me that was very neat was there was breakout sessions. So we all came together as a big group, and then we had several breakout sessions. And in these breakout sessions, we were given questions before we went in there. And we had to, answer these questions among a group of people. And it just so happened that I was in a breakout session with people that I'd never met before in my life, I don't think. And it was a really interesting experience that I didn't realize at the time, but I kind of reflected on after the fact was, man, I was in a room full of people that are complete strangers and like we're having like real conversations about our goals and our struggles and where we need to grow and all of this stuff. And anyway, pretty cool experience to just be with a bunch of like-minded people, right? Everybody that's there is there for a sole purpose, and that sole purpose is to grow and improve ourselves. And so we all have an aligned goal, I guess, when we're there. Anyway, both of those are really neat. One of them, it just cost us some books, right? And an hour a week, and we do it with our own team. So it's a little more informal. It's people that we know, right? So there's a couple options for you. I still listen to podcasts all the time. I have about a 45-minute drive to and from work, and I pretty much just listen to either podcast or audiobooks or something along those lines while I'm driving back and forth to work all the time. So I'm always trying to consume something. And something that I learned from Chris Robinson and from Drift to Drive is a lot of the stuff that I listen to is me listening and hoping there's something in there that means something to me. And I'm not being very intentional about what I select to listen to. And so one of the homeworks, quote, from his book is to intentionally select 10 things that you're going to consume that are going to help you get to your goal. And so I'm pretty excited to see what I can find there. And what happens when I sit down and actually spend some time searching for something with intention and with purpose instead of just, clicking on the next thing that looks good. But anyway, enough about that. Oh, I will say, if you got any suggestions of anything to listen to, let me know. Books or podcast or YouTube or whatever. But past that, thank you all for being here. I appreciate everyone that listens to this show. As always, it's the reason I do it. It's for you. So if you have any suggestions or questions or ideas of a show topic or anything like that, then feel free to shoot those over. If you like what you hear and you want to leave a review or share it with a friend, that would be greatly appreciated. It's all just trying to get good information. Well, in my opinion, it's good information, right? I sit here and say it. So that's the whole purpose, right? Is trying to get information that I believe to be good out to as many people as possible. So if you want to help me with that, that would be awesome. All right. So let's get down to the show. And I will say Jamie is our media guy, and I believe that he may have our first video from Fence Tech. I don't think it's been published yet, but if it hasn't, it will be soon. And there's going to be a handful of videos that come out from Fence Tech, just kind of trying to show. Really, we just went around and found the things that we thought were cool, and some people that are partners here on the show and different things like that. And so that's what all the videos are, right? Nobody's trying to sell you anything. It was just things that I found interesting that we went around and looked at. So if you want to check out some cool stuff, make sure you watch those videos. All right. So let's get to the topic here. That intro was super long. Let's get to the topic. So like I said earlier, we've been talking about this, be careful what you consume stuff all year, and kind of getting away from that a little bit right now. May or may not go back to it. You never really know what I'm going to do. I might say that I'm going to start some new series and only do one of them. Who knows? Just whichever way the wind blows, right? But anyway, as I said in the very beginning of the intro, I've had some conversations with people who they needed to understand the basics of their financials and what basic financial terms were and how an income statement was structured and all of these things. And as a result of these conversations, I decided I would do another episode about it. And that's kind of what led us here. So there are so many people that need to hear this information, and I hope that this reaches some people and is beneficial to them. So, like I said earlier, share it with somebody if you think they might need to hear it, right? I think all of this, it's so important to business. It is essential for us to track is one piece of it, right? But not only to track it but really to understand the financial data and why are we tracking it? What are we tracking? What does it mean? If we want to understand our business, then that is the way for us to understand what our business is doing. So let's try to cover this stuff. I'm going to try to stay at a high level. I'm not trying to get down into the weeds very much. If you have any questions about any of this stuff, feel free to call. I'm happy to talk about it. But I want to try to keep this a little higher level. So, part one is the very basics. Okay. So, financial statements are standardized under the generally accepted accounting principles or GAAP. So, what I'm going to say, these are not my opinions or just stuff that I made up or the way I do it, right? It's structured framework and it's used by banks, investors, the IRS. One thing that might be of interest to you is if you ever decide to sell your business, having all of this stuff in order is going to be very important. It's kind of hard to sell a business if you're like, oh, yeah, I have tax returns from once a year. Like, nobody's going to want to look at that stuff and try to figure it out, And you're certainly not going to get as much money for your business as you would if you had proper financial information. So, proper financial information is a really big deal. So let's get to part number, the first item in the very basics is revenue. So revenue is the total income generated from normal business operations before any expenses are deducted. Under the GAAP, generally accepted accounting principles, revenue is recognized when it's earned and realizable, not necessarily when cash is received. I'll touch on that a little bit here in just one second. Revenue is also called your sales or top line revenue, like that. There's a lot of financial terms that are kind of like interchangeable, right? And so there may be like 2 or 3 different phrases that mean the same thing. So again, revenue, sales, top line revenue, like people have different words for it. And it does get confusing. Okay. And so what I try to do inside of my own organization is I try to standardize the terminology that we use. And I try to do that for everything. So if we're talking financials, if we're talking about gates, if we're talking about doing this show, like whatever it is that we're talking about, I want us all to use the same terminology. That way everybody is crystal clear. Okay, so I would suggest inside your organization, just kind of standardize whichever phrase you like. So there's a difference in cash basis and accrual basis accounting. Okay, so cash basis shows when the money actually moves. So when money is received into your bank account or when money leaves your bank account or your pocket, right? Whatever. So when you collect cash or when you send cash, that's when the entries are made or when it counts on your income statement if you're operating under a cash basis. If not, then you're operating under an accrual basis. It shows when the economic activity occurs. Okay. So when you create an invoice or a bill internally, it shows up as revenue on your income statement. If you're cash basis, it shows up as revenue when you receive the cash. Accrual basis shows up as revenue when you create the invoice. All right. So hopefully those kind of make sense. There's some guidelines and some rules, and the IRS has thresholds and stuff like that about who can be cash basis, who can be accrual basis. But a lot of small businesses are allowed to use cash if they meet the IRS gross receipts tax. And from what I saw, you average less than 25 to 30 million in annual gross receipts over a 3-year period. Okay. I would, you can feel free to do your own research on that. I didn't do a ton of research. I just kind of looked and took that response and I was like, okay, yeah, that looks right. But just know that there's some sort of threshold or some sort of rules that the IRS actually has to where at some point as your business grows, you have to change from cash to accrual. But larger companies, they're typically have to be accrual based accounting, right? And then there's some other scenarios. So if there's some sort of rules that if you carry a large inventory, I have no definition of what large is. I don't know if that's $50,000 or $500,000 or 5 million. But the part that I can speak to is banks, bond companies, investors, anyone looking to buy your business. There are a lot of those type scenarios where they want accrual based accounting. So, what does that mean for you if you're operating a business? Well, when you create an invoice in QuickBooks or whatever accounting system that you're using, like you're billing the customer out of there, right? So the job is done. You create the invoice, you give it to the customer, and then they pay you. And so the only difference is when the entry occurs on your books. And in QuickBooks, there's just a little toggle at the top. You can switch between cash and accrual. So assuming you're actually invoicing out of QuickBooks, entering bills in QuickBooks, things like that, like you have both options in there. So if you're only entering bills, so to speak, when money leaves your account, like if you have it linked to your account and you're only recording the transactions when money goes out, then you only have cash basis, right? So even if you switch back and forth, you don't really have both. But sorry, got down a little rabbit hole there with the cash versus accrual. Hopefully that made some sense, but just let's go all the way back to the top real quick. Revenue is the total income generated, not profit, the total sales or the total invoices, right? The top line revenue is just your total invoiced amount or your total sales amount. It is not the profit of your business. It is not how much money you made. Okay. It's maybe how much money you earned, or how much money you generated, but it's definitely not how much money you made. All right. So as we work our way down to P&L or income statement, next thing we run into is cost of goods sold. So your cost of goods sold is direct costs that are attributable to the production of goods or services a company sells. Sorry. The hick in me came out there for a second, I reckon. It's time for a tea break. Okay, so cost of goods sold, the direct cost attributable to the production of goods or services a company sells. So, according to accounting principles, cost of goods sold includes direct labor, direct materials, subcontract labor, equipment cost, things like that. It does not include office salaries, rent for your office, marketing expenses, any administrative cost, your phone bill, your insurance bill, none of that. Oh, insurance is actually there. There's some scenarios where insurance might cross that line, but anyway, for now, all of your general cost do not go in cost of goods sold. So you buy material for a job, cost of goods sold. You rent a piece of equipment for a job, cost of goods sold. Now, this is an interesting scenario. I was asked about this earlier, and they say, "Well, what if my auger breaks while I'm trying to do a job and I have to go rent another one?" And I thought, I would put that in expenses, right? Because it's a piece of equipment that you own that was broken and you had to rent an additional piece of equipment because that one was down. To me, that's an expense. Well, what if we get on a job site and there's some unforeseen circumstances and we have to rent a piece of equipment to accomplish that job? Now, that is cost of goods sold because you had to rent that piece of equipment specifically for that job. It's cost of goods sold. The broke piece of equipment that you had to rent a replacement for, not necessarily specifically for that job. Yeah, you may have been working on that job, but if you were working on the next job and the equipment broke, you would have had to rent one, right? So hopefully that makes sense. I liked the question. I thought it was good. But cost of goods sold, any direct cost for the job. So I kind of in my mind I cooked up this simple test, right? Little easy test. And I imagine I open my mail or my email and there's a bill in there. And I look at that bill and I know what the purchase was for. And I say, "Oh yeah, that was for John Doe's job that we installed 2 weeks ago." Right? That kind of response means it's cost of goods sold. If I look at the bill and I'm like, "Oh yeah, we just had to have that because we're a business and we operate and we do jobs." That is not cost of goods sold. I'm just there was a dramatic pause for you. So, open the bill, you know what job that material was for or that purchase was for, cost of goods sold. All right. So, you have revenue is what we invoiced. Cost of goods sold is, let's just kind of high level material and labor that it took to do that job. Maybe some other miscellaneous things that go in there too. So, when we have those two, the next item down on an income statement is going to be our gross profit. So, gross profit is just revenue minus the cost of goods sold. So, when you hear people talk about margin, that is this number that we're talking about. Okay. Again, revenue minus cost of goods sold. So, typically, your margin is talked about as a percentage, which is just gross profit, or yeah, say gross profit divided by revenue equals your gross margin. So, the defense industry, whoever's have decided that 40% margin is the standard of the fence industry. I hear. I don't know. If that's the case, then when you look at your P&L and you have revenue, cost of goods sold, and then you have gross profit, your gross profit percentage should be 40% of your revenue, 40% of your sales. Okay. So this really is like how efficiently you perform work. Is kind of what you can look at, especially if you get multiple years of data. So that's one thing that I'll look at. I'll look at it and I'll say, man, our sales increased 10%, but our cost of goods sold increased 12%. So we lost some efficiency, right? But if our sales increased 10% and our cost of goods sold only increased 6%, well, now we made some efficiency. And so I kind of do like that very high level. I know I keep saying that, almost a very dumb comparison, but I didn't want to be offensive. So I just kind of do that like comparison, right? Because it makes really good sense in my mind that if we did 10% more work, then it should have taken 10% more material and labor to do that work in theory. So I can kind of see immediately year over year how our performance compares. And I think when we calculate material and we manage the whole cost fluctuation and like that material side of it, like that's our performance. And then when we dispatch crews and we manage installations and our crews do installs and stuff like that, that's our performance, right? And so that's how I can look, and the reason why I say our performance. All right. Hopefully that makes sense. If anyone has any questions, you know where to find me. So if our revenue is $1 million and our cost of goods sold is 700,000, that leaves 300,000 as gross profit. Okay. 300,000 is 30% of a million, which means 30% gross profit. I'm going to say that one more time. $1 million in revenue, cost of goods sold is 700,000. So 1 million minus 700,000 equals 300,000, which is our gross profit. And that is 30% of the million. So that means 30% gross margin. Okay. So our gross profit is what pays for everything else. Okay. It pays for all of our overhead expenses. It pays for our profit. It's going to pay for any new equipment we have to buy or tools we have to buy or advertising that we want to bump up or property that we're going to rent or buy or any kind of expansion that you can think of has to start with gross profit, and it has to make its way all the way down to the bottom line. We'll get there in a minute, but that's the only way we can expand and we can buy things as if we're profitable. So it's actually, I think that's a thing that isn't very well communicated And I don't know this for sure, but my suspicion is it's a thing that's not very well communicated. I believe that I understand that, and I don't know how well I communicate that to other people, right? That, hey, when somebody wants to buy a new truck or we need a new skid steer, or right now we have to buy another side by side. Ours went in the shop, 16 years old. It's an old Honda Big Red or something like that. And that thing has been pretty well bulletproof. I remember when I bought it, it was already a few years old. I bought it at a dealership. It was used. I think an older farmer had it, had been really well taken care of. And when I went over and I looked at it, I remember the guy's like, yeah, if you want one that you're going to have to work on every now and then, but it's fun to drive, buy this one. If you want one that you just get in and turn the key and it goes every time you sit in it, buy that one. And so we bought the Honda, which was the one that just you get in and turn the key. And it's been really solid. But it went to the shop and it needed like, I think $6,300 worth of repairs. And I was like, yeah, I don't think so. Like that's a little much, right? So I'm gonna go shopping and see if I can find another one. And the reason that what's gonna pay for me to go buy that new piece of equipment is profit. And without profit, there's no way to buy that equipment, right? If we want to expand and add on another crew or another person in sales or management or whatever that is, like we got to have some profit set up so that we can pay them until we get to the point where they start paying for themselves, right? Um, it all comes from profit. A business can't survive without profit, right? Because something is going to break, something's going to have to be replaced. It's just inevitable. You got to be profitable. And how do you know when you're profitable? Well, you track all of these things we're talking about and you understand them and you analyze the data, right? That's the second big piece of it, is to actually analyze the data and understand what it's telling you. And if you do all of those things, now we can figure out if we're profitable or not. All right. So, margin, gross profit. We got to understand that number if we want to bid jobs properly. So let's all just decide that we're going to stop winging it, right? We're all going to learn to actually do it right. And we're going to start right here by learning and understanding and growing and improving. And this is not like nobody's saying you have to do this stuff overnight. Okay. Take your time, figure it out, get it done. So let's recap what we've covered real quick. Again, I'm going to go to the top and just kind of keep running back through this thing over and over. Revenue is what you invoiced, what you billed, not what you sold even, right? We can go out and if we sell $500,000 worth of fence this year, but we can only do 100,000, guess what? Our revenue is still only 100,000. Okay. Cost of goods sold is our direct cost of installing the job. Again, remember the simple test. I open the bill, I look at it, I say, oh yeah, that was for Susan Smith, right? We had to have that material, that equipment, that whatever to do that job. That's cost of goods sold. If we look at it and we didn't have to have it to do that job, but we had to have it to run our business, it's something else. Gross profit is the difference between those two. Revenue minus cost of goods sold equals gross profit. When you do the calculation and you make gross profit a percentage of revenue, it becomes your margin. All right. Margin is what we need to bid jobs. Okay. So let's talk about our operating expenses, frequently called overhead. So the definition: operating expenses are the indirect costs required to run the business that are not directly tied to producing a specific job or a specific product that your company sells. Okay. So again, I'm not going to do that again yet. You're going to have to wait. I know you're super anxious. All right. So let's talk about, what do these include? Office salaries, administrative payroll, your rent on your office or your shop or the laydown yard or whatever, your insurance, any kind of software subscriptions you might have, your marketing budget, any kind of legal services, accounting services, anything like that. Vehicle expenses. All right. So repairs, maintenance, things like that are expenses. I wanted to pause there for a second and be specific about that. Repairs and maintenance are expenses. Buying a truck is not an expense. All right. It becomes a fixed asset, which is depreciable, can be depreciated. I don't know if I messed that up or not. But anyway, buying that truck is not an expense. Operating expenses are somewhat fixed, right? Some of them don't change. Like if you can increase your sales by 50% and operate out of the same office that you're in today, that's not going to increase, right? But there are other things that will. So obviously, general liability insurance, workers' comp insurance, things like that are going to increase with your revenue increases, your payroll increases. So some of your overhead is fixed, some of your overhead is not. So back to my simple test. I look at the bill, I think about what job it's for. It was not for any job. It was just to run our business. It goes into my expenses or my overhead. Okay. So I told you some of them are fixed, some of them are variable. Fuel is another good one, right? And maybe your sales admin staff, like if you, double your revenue, maybe you need another salesperson, or maybe you need someone else in an admin role, another manager, something like that. Like that's going to increase. Fuel would increase because you're driving to more job sites. So some's going to grow, some are going to stay fixed. You can spend some time and figure out which ones are which. Now we get to the fun part. Well, hopefully the fun part, hopefully not the super depressing, terrifying part, because I've experienced both of those and I hope that yours is fun. Net profit or net income. Okay. So that's the amount remaining after all of your expenses, including cost of goods sold, operating expense. Yeah. So your cost of goods sold and your expenses after they're deducted. So revenue minus cost of goods sold equals gross profit. Now we subtract expenses out of that. That equals our net income. There's some more things that can go down here, but for now, like I said, we're going to kind of keep it high level and not get too far into the weeds, but that's the basics. Okay. So, sorry. So this is sometimes called the bottom line or your bottom line profit or like whatever terminology you want to use. This is actually what you made. Again, don't say, well, I made $1 million in 2025 if you sold $1 million, right? You can't sell $1 million and make $1 million at the same time. It's going to cost you something to do the work. So just make sure your terminology is right and understand words are important. So companies can be super busy and have very little or no profit if your margins aren't what they need to be, if your overhead is too high. And if you're not tracking those numbers, you're always going to wonder why you work so hard and you never have anything to show for it. But there's light at the end of that tunnel, right? You can track the numbers and you can figure out what's going on. And you can even like expand on that and keep getting more complex, maybe more efficient, more proficient at tracking all of this stuff. And you can get into doing job costing. And then you can know which jobs you're making money on and which ones you're not making money on. So when you get here, again, look at the data, understand the data. Don't just look at some piece of paper that a CPA or your, accountant or whatever brings you once a year that you don't really understand anyway. Right? You got to learn the stuff and you got to figure it out. All right, that was part one. So now let's talk about part two. Part two is shorter. Don't worry. So part two is what our income statement or our profit and loss statement, P&L, what it tells us. Okay, so the P&L summarizes revenue, cost, and expenses over a specific period of time. That may be a month, that may be a week, that may be a quarter, it may be, a year, maybe 6 months, like whatever it is. So everything we just went over goes in the P&L and it goes in that order. Revenue, cost of goods sold, gross profit, expenses, net income. Okay. That's kind of the order of a P&L. And so So I did that intentionally, right? Went over it in the right order. So as if you start at the top and you kind of read your way down. So maybe you have one and you don't really understand it. Well, guess what? Go start this thing over and you can go through section by section and you can listen to what it is if you want. So what does it tell us? Well, obviously it tells us if the company was profitable in that period. Okay. Now, just keep this one little disclaimer in mind that there can be weird timings on stuff sometimes. So if you try to look at a really short period of time, if you try to look at a week and you're like, "Holy crap, we didn't make any money this week." Well, how many jobs did you start this week but you haven't billed, right? Or how many jobs did you bill last week or, like you see what I'm saying, right? The timing can be really skewed. So if we have a really big job that we've been working on all week long and we haven't billed anything on it, well, we might have 0 revenue this week and we still incurred some expenses, right? We still got the bill for the electric or we still got the bill for the insurance or whatever that is. So timing is weird, especially when you look at little periods of time like that, but even when you look at a year, because you might have a job that you're working on in December and you incurred 90 or 95% of the cost in December and you might not bill anything until January. And so your cost of goods sold is going to be inflated in December, and then your revenue is going to be inflated in January. So there's always a cutoff. No matter if you look at it weekly, monthly, quarterly, annually, whatever it is, there's always a cutoff. And so just kind of keep that in mind. Now, when we look at our P&L, it's going to show us what our margins need to be. Okay. Remember, when we bid a job, we need to bid the job based on the margin. So our margin is our expenses plus our profit. So we're going to bid jobs that way. We're going to accurately calculate what the cost of goods sold is. We're not going to guess and we're not going to say, "Oh, yeah, I don't know. That looks like it's about $12 a foot for the material." No, come on. I mean, just break it down. And even if you're going to try to do that price per foot, like at least break it down at some regular basis. Don't do it once a year when you have nothing else to do. How much does material cost fluctuate over the course of the year? So just kind of stay on top of that stuff. But we know what our cost to goods sold has to be. We know what our margin has to be because we know what our overhead is and we know what our profit has to be for our business to survive. And that's how we get to the sales price, right? We can take our cost of goods sold plus our margin, which is expenses and profit, and that's going to get us to our sales price. So again, stop guessing at it. Just start learning. It's okay. It's going to take some time, but you can get there. So I went through this little scenario in my mind earlier and I thought, man, imagine you've been in business for 20 years. Okay. You've never understood your P&L. You've never understood any of these financials. Maybe you get some sort of statement from your, accountant or your CPA or whatever every year. And you're kind of like, yeah, okay. Like, I don't really know what any of this stuff means, but there's a lot of numbers on here. So it must be good. Right. And you never took the time to actually learn it. You just always knew there was some money in the bank to pay your bills and you could get by. You never had enough to go out and buy a truck or, the truck you wanted at least. Never had enough to go buy any equipment, anything else. So imagine you took the time and learned all of this. And then imagine that you just kept learning, right? And you kept building on the knowledge that you had and you kept expanding your accounting practices or kept improving your accounting practices over some time. And then imagine you got to the point where you were able to start doing job costing and you figured out, well, first of all, if you just have basic financials, right? If you just get to the point where you have a solid P&L, you really know how to bid a job. And that's so important. And how many people out here in this fence industry bid jobs without really knowing this information? It's absolutely terrifying to me, right? Because it's terrifying to me because that's what we're expected to beat a lot of times, right? If we're in a scenario where we're bidding price versus price, that's what we're expected to beat. And then the other thing that's terrifying is just for them. Like I wouldn't want to go through 20 years of just getting by, right? And I feel for the people that do it. And so then we get to our basic financial, right? And then we keep going and we get to the point where we're doing job costing and we really dig into this data, right? Because we realize, wait a minute, there's some really important stuff in here. And so we just keep expanding, we keep learning. And then we're doing job costing. And then we realize every time we install a chain link fence, we're losing money, right? Because we've been charging $2 a foot to install 4-foot chain link since 2003. And that's just what we charge. Well, yeah, might not be a good idea, right? And so you see, every time you're doing a chain link job, you're losing money, or maybe a wood job, right? Or maybe every time you install gate automation, whatever that is, like you can start to notice those patterns, and you can start to figure out, okay, when we do this type of job, we make the absolute highest margins doing that job. We should really go after those, right? We should really make sure that we capture every opportunity we possibly can to do that type of job. That's a really cool place to be. When you can get to that information, it's really cool. And it's really powerful. Okay. So hopefully somebody out there is a little bit motivated and a little bit inspired to actually know what's happening with their business. Right. So let's figure out what's happening with our overhead. And then you get this magical moment where you have 2 years, and then you have 3 years, and then you have 4 years, and then you have 5 years, and then you have 10 years of data, and you can put them all on the same screen side by side, right? And then you just sit there and you look and you go, okay, let's look at our marketing budget, right? Why did we go from spending 2% to 1%, and then to 0.5%, and then back up to 4%, and now we're at 12%? When I say percentages, I'm talking about percentage of revenue, right? And you can start to see those patterns. That's a random drastic example, but you start seeing those patterns across time, and you can see the things that just creep up and up and up and up over the years, because I promise you there are things that do that. And if somebody's not watching and keeping their eye on everything, that stuff's going to happen, right? How much did we pay for internet 5 years ago versus how much are we paying now, or whatever? And so all of those costs go up, which means we have to react. Okay. Or we have to be proactive, even better. But we got to know the data to react or be proactive, either one. And we can look and we can see, where's our money being spent. Right. And then again, just start tracking those trends. So the year to year to year to year comparison is super cool. Being able to compare this quarter to the last 4 years, quarter one, is really cool, right? Because now you can start to see, oh, wait a minute, we're doing really well or we're doing really bad. So we need to like get out there and hustle next quarter because we got some stuff to make up for, right? Or maybe this is going to be an awesome year and we need to start thinking about tax planning now, right? So having the data gives you all those abilities. Okay. So our P&L is going to measure our performance. It answers the question, did we make money during this period? You've probably heard, but way back when I bought Memphis Fence, so I bought it in 2013 from my dad. And when I bought it, the accounting was done on like notepads, right? If you wanted to know the cash balance in the bank, it was on a notepad. And every time deposits were made, they were written on the notepad. Whenever a check run was done, like one amount was written on the notepad. And then you would get a financial statement from the accountant, the CPA, at the end of the year, right? And you really could see a P&L and you could see a balance sheet and you could see stuff like that then. But it was never accessible throughout the course of the year. And I would hear a lot of people be like, "Oh man, we made so much money on this thing. We didn't make no money on that. We did good on this, did bad on that." And I'm like, at first I just kind of went along with it, right? I didn't know any better. And I finally got to the point and I was like, "Wait a minute. How does anybody really know?" It gets all just kinda like gut feeling type stuff, and I mean, yeah, I guess if you know you bid a job and you put, 6 days worth of labor on there and you got it done in 4, okay, you probably made money, but, I mean, did you spend an extra 30% on the material? I don't know. And so, I knew whenever I bought it, I definitely wanted to have some accounting stuff in place, and I wanted to be able to see data, and fortunately, my father-in-law, who was a career CPA and accountant, it worked out to where he came here and he hung out and he's still here. And he was able to definitely help get us headed in the right direction with getting our books in order and getting QuickBooks set up and getting all this stuff in place so that we could track all these. Now, let me tell you, what's happened since then is we've changed the way that we do stuff a lot. Okay. And so there's nothing wrong with getting started and then realizing it could be better, or you could have more information available and just keep building on it. Right. That is, in fact, what I would encourage every single person to do is just get started. You can always improve it later. And guess what? You're going to make some mistakes along the way. That's anything in life. All right. So the key of it, just get started. But our P&L measures performance. Okay. It answers, did we make money during whatever period we're looking at? It does not tell us how much money we have, how much debt we have. And it really is kind of a piece of the puzzle if we're financially stable, but it's not the full picture. Okay. So that's we've made it to the end. Right. And I hope that, again, I hope some folks take this stuff seriously and stop winging it. And please have some data to show your banker or your investors or the people that want to buy your business. Or if nothing else, just have some data. So when you go lay your head down at night, you can sleep well knowing actually what's going on. And I'm going to leave you with a quote. I have no idea who it's from, but it's a quote. Revenue is vanity. Profit is sanity. Cash is reality. And discipline with your numbers is the difference between owning a business and just having a job. I'll see you next time.